Hello traders, my name is Christopher Vecchio, currency analyst with Daily FX. Today is Monday, July 28th, 2014. These are FX headlines as we turn the page to a quiet North American session. A very quiet day overall, in fact, as we see that the economic calendar is only dotted with a few events from the United States today. We have the market composite PMI and services PMI due out at 1345 GMT, U.S. home sales data, pending home sales at 1400 GMT. And that's about it. So the focus overall, the overarching theme this week would be on the Federal Reserve meeting on Wednesday. We're lucky enough to have the Fed on Wednesday and then U.S. NFPs on Friday. And Friday is just going to be a spectacular day for economic data. NFPs, we have ISM, we'll have confidence surveys as well. So a lot to look forward there. But in the interim, we have to keep an eye on what the levels are in the index, the U.S. dollar pairs. And quite frankly, regardless of our opinion of what's happening on these various data prints, won't matter if price doesn't achieve those said expectations. So keeping that in mind, we turn our page to the chart here, and it's starting to look like the dollar is actually gaining steam overall the last several days. This comes as the U.S. yield curve has gone through a bit of an interesting twist, so to speak. In the belly of the curve, 3 to 5 year notes over the past month, yields have moved up a little bit. Not too great of an increase there, talking about just about, say, 10 and a half basis points in the 3-year, whereas in the long end of the curve, there's been a bit of flattening, where the 10-year is down by about 5.2 basis points over the last month, and the 30-year, approaching 13th month lows, is down about 11.6 basis points over the past month. So this isn't indicative of an economy that's necessarily there to back the strength of the dollar. A flattening yield curve in this case bodes poorly. No one really likes a flat yield curve, as the saying goes. But for now, the dollar is still taking advantage. So maybe we're going to see some better than expected data in the short run. Maybe expectations for the Fed withdrawing liquidity, raising rates in the short term is high. But in terms of the overall U.S. inflation and growth picture, there's a lot of uncertainty out there, especially as wage growth remains low. Regardless, U.S. dollar remains on track right now. As long as we hold below 134.75, the former yearly low and breakout level from last week, if we hold below 134.75, U.S. dollar bull should remain intact. Right now, we're looking for a move down towards that 133 area, maybe a little overshoot from the late November or early November 2013 low. We say that because dollar Swiss looks like it wants to run higher as well. It's trading up at 90.40 right now, depending upon how you measure it, either this double bottom, which admittedly isn't the cleanest given the price action at the end of June, or the extension from the breakout of this particular downtrend. That's the May 8th low taken to the June 5th high and then back down to the July 1st low. We see that we have a target zone between these 100% extensions between 91.60 and 91.89. That's about 1.2% higher from where we are presently, and if we were to subtract 1.2% from euro dollar, that brings us right down to 132.70, 132.80, depending upon if you measure it at 134.30, 134.40. And we say that relationship, and note that relationship, only because of dollar Swiss and euro dollar since September 6, 2011, when the S&P implemented that 120 floor in euro and Swiss have traded to about a 0.92 daily correlation positive, exceptionally significant, nearly perfectly positive. And so if euro dollar is due for a further decline, we're probably going to see dollar Swiss continue its run higher as well. Pound dollar is by far, I think, the most interesting one that could be in the midst of a market turn. We only say that because the last 2 times we've had MACD reach these levels, the histogram, this negative, it came right near the bottom of price. In fact, the last time in March, we had 2 more days of selling after, and it was actually the low. The low in the swing down at the end of May, pound dollar. We're coming at a pretty important level now, 169.20, former resistance, now support, also support in the uptrend from November 2013 and June 2014 lows. At this point in time, if we do see a break below 169.20, there's more evidence of a stronger dollar turnaround. Finally, the last pair we're looking at there, dollar CAD, Dollar CAD looks like it's really getting ready for its next leg higher. We've been watching this for several weeks now. Came into support off of the September 2012, September 2013 lows, capped by that 108.15 level. But now we're breaking the March downtrend. We're seeing stochastics are breaking their pattern from the decline, climbing through that 62 level, and MACD is getting through that zero line. So a weekly close through 108.15, and dollar CAD could be well on its way back towards its highs near 112, as it does look like this may be a little bit of a falling wedge pattern. That's it for me today. Of course, again, this is a very quiet economic calendar. Today in particular, we'll be keeping our eye on waiting out for the Fed on Wednesday. Until then, I'll have a trading Q&A tomorrow morning, 6 Eastern, 10 GMT. We'd love to see you then. If I don't get to speak to you before then, good luck trading over the next few days.